Hi, this is Alvin from Dr. Wealth, and today I want to share about Singapore bank stocks and to show you the track record of the three local banks and how resilient they have been through the crises and how their dividends have been distributed over the last 20 years. And lastly, we look at some of the tailwinds that the bank stocks will enjoy in the short, medium to long term. So let's begin. And Singapore banks dominate the Straits Times Index. I believe some of you already know this. That three banks add together, their weightage in the STI index is 43%. 43%. And that means that in the 30 component index, the other 27, it's 57%. Right? So you can see how much influence the three banks have in terms of the stock market capitalization as well as the Singapore economy, right? It is a reflection of their contribution or their influence to the Singapore economy. So these three banks are highly watched by a lot of investors. Their performance is also a reflection of how our economy will move as a whole. Okay, and then when we compare beyond Singapore in the region in Southeast Asia, the three Singapore banks are in the top three in terms of the amount of assets under their care, right? So we can see DBS is the largest with almost 500 billion assets, and then OCBC and UOB are closer in the second and third places, and then thereafter are all the other banks, right? Malaysian banks and Thailand banks. So you can see even in the region, the three local banks are pretty influential as well. And let's look at some of the bank metrics for these three banks. There has been a falling net interest margin since around 2009, right, to today. And this is not the fault of the banks, right, because it is a reflection of the global low interest rate environment that started from the US in 2008 after the financial crisis. They did a lot of quantitative easing, print a lot of money, lower the interest rate to zero, right, over the last 13 years. And this falling net interest margin is just following on the low interest rate environment, right? Of course, a bank will benefit from higher net interest margin because essentially they are taking money from depositors and lending out to other borrowers. So you want to be able to lend out at a much higher rate than the amount that you promised the depositors, right? And because of the low interest rate environment, you can't charge an arm and a leg to your borrowers, and that is where they do not enjoy a fat margin that making out from all these loans. All right, so but with a rising interest rate, the potential or more room for the banks to play around with this margin will come about eventually. All right, so that is what has happened in the last 20 years, 15 years, okay, in this chart. Next, on the non-performing loans, it has been pretty stable and low since 2007, even during the financial crisis in 2008. It has been very, very stable, below 2%, right? There was a bit of jump over here. DBS non-performing loan crossed 2% in 2009 after the financial crisis, but it has stayed low ever since. All right, and compared to prior to 2008, it's even higher, right? There were periods where it was almost 10% non-performing loan. That's just too high. Okay, and that was because of the aftermath from the 1997 Asian financial crisis, which hit the banks a lot more than the 2008 financial crisis. And a lot of lessons were learned. One of it probably would be increase the loan quality, all right, and that drives down the non-performing loans to today's level, which is pretty resilient, right? Even in 2020, the COVID didn't really bump up these non-performing loans by much. And then the third thing is the stable adequacy, capital adequacy ratio. All right, it's been pretty much the same since again 2008 financial crisis. All right, maintain an adequate level of capital or reserves in the bank to prevent a bank run in case any crisis happen again. All right, so you can see that during the great financial crisis, the capital adequacy ratio actually went down. Right, so that was that impact. And if it goes to very low levels, a bank run will happen. Okay, so now it's pretty much stable, and again 2020 there wasn't a hit by that. So the banks have really learned a lot over the years through this crisis, and they have built better system, better policies, and I think that MAS have also done a good job in using policies to shape the bank behaviors. Okay, so fundamentally I think the three banks are pretty sound. And let's look at their dividend per share. For DBS, this is a 20-year dividend per share chart. Okay, you can see that For 20 years, DBS have given out dividend every single year, even during crises, right? Like the SARS in 2004, like the financial crisis in 2008, they still give out dividends, and COVID last year, they also gave out dividends, right? And it is a general trend that is on the rise, okay? Even though it doesn't rise every year, sometimes it even go down, but on the long-term trend, the dividend per share trajectory is going up. All right, so that's a good sign, right? That means the banks are also growing and they're able to give more dividend per share to the shareholders, right? So you also enjoy that. Imagine you started off with just 25 cents per share of dividends in 2001, and now you enjoy almost 100 cents, right? Almost a fourfold increase. Okay, so that is what a good bank should do, right? They should be able to give you dividends throughout the crisis and even grow its dividends over a long period of time. OCBC is even more fabulous, you can see. Okay, they have never lowered their dividends, right? It has been always going up, even during crises in the past, right? It has always been going up. It's either stable or going up, right? Same as the previous year, or it has been going up. It's only COVID it went down. And it's not that OCBC cannot give out higher dividends, it's that they were capped by MAS to give out just 60% of their dividends per share of 2019 financial year. The reason is because the MAS wanted the banks to have more cash reserve just in case the crisis unravels itself, right? So it didn't, and later I'll share with you what happened. Okay, the banks actually increased their dividends in 2021 that compensate for some of the lost dividend that was in 2020. This is UOB, right? Same thing, they have given out this dividend for every single year in the past 20 years throughout the crisis. It is more jagged, not as smooth as what we saw in OCBC, but it's the same principle. The general trend is up, okay, right? And of course, COVID, they were also imposed by the dividend cap by the central bank, right? So you can see all three banks are pretty similar. They have performed well. They have become more resilient. In fact, almost every metric that you see, they are all very close together, right? They're all very close together, okay? Even the net interest margin here is also very close together. So I think there are very little differences in terms of their metrics, their fundamentals, okay? Later we'll look at some other aspect to see where the difference lie in. So I mentioned about the COVID dividend cap. That happened in July 2020 last year. MAS capped dividend distribution to 60% of FY19 dividend per share. Okay, and in July 2021, they think that the threat is no longer there. We are on a recovery mode, and MAS lifted the restriction, and that's where the dividends start to increase in 2021. And as of first half, we can see that. You see that DBS 51 compared to last year, there's no change, right? But in 3Q, there's actually a 20+% increment already, right? So they continue to give more dividend this year compared to last year. Okay, so they add another 33 cents here, and last year was 18 cents, right? So that was where the increment come in. So I believe a full year would have a more significant increment in dividends compared to 2020, the COVID year. For OCBC, by mid-year, they have already raised the dividend by 57%. Likewise for UOB, they have already raised by 54%. So you can see that COVID didn't really hurt the three banks, right? They were more than resilient enough, and their business, in fact, did better in terms of the wealth management, right? It grew, more people were investing, and they were able to distribute higher dividend this year. And this is the impact. I wanted to compare FY20, which is the COVID period, and also bring in the pre-COVID period, which is the 21.9. So the percentage change is between these 2 years. So for DBS, the revenue just dropped 0.3%. OCBC 7%, 8% for UOB, right? Not very drastic kind of impact. And for net profit, it's down by a quarter, or UOB is down by a third. Again, not drastic kind of impact to the three banks, right? They are still profitable even in a COVID year, just less profitable, right? So they are pretty resilient. Okay, yeah, that crisis didn't even really hurt them. And let's look at their valuation, right? I like to use the price book range to determine where is a good price to enter. And this is a 10-year chart. Just want to explain a bit more. For the book value, I use yearly book value. That means I use the last financial, the FY book value. By right, the book value will change every quarter. You can update it, but I just use the FY book value, which means that if you plot the different chart, it will look slightly different. All right, but it should tell you more or less the same thing. Okay, so the average price to book here is around 1.25 for DBS, and now it's at 2 standard deviation. Okay, this line is a 2 standard deviation, so it is overvalued for DBS. And I think that being the most prominent bank backed by the government, a lot of investors don't mind buying the top bank, and it's the largest Singapore stock listed on SGX, right? So it does have a premium compared to the other two stocks, bank stocks. So OCBC is cheaper, right? You can see it's trading at slightly above 1 PB, and this is -1 standard deviation, right, from the average. So it shows that it is slightly undervalued. Okay, so comparing between the two, OCBC gives a better value for money price valuation. For UOB, slightly just off the 1 standard deviation, right, and this is the average. Okay, so still cheaper than relatively cheaper than DBS, right? Closer to OCBC, but slightly more expensive than OCBC. Okay, so out of 3, it looks like OCBC offers the best bang for buck at this point in time. So this is another comparison chart that you can see based on their share price. That because the share price will move, I need to lock the price at some point in time, and the PB. Okay, this is again a historical PB. I base it on the annual book value, right? The quarter book value should improve these numbers, maybe 1.5, 1, and 1.1, right? It should lower a little bit for the price range, but relatively it will still show the same relationship. In terms of PE, I also use the historical EPS, right? So you can see it's 14, 11, 14. So in terms of PB, OCBC is cheapest. In terms of PE, OCBC is also cheapest, right? This is a relative comparison, not just against its history. And in terms of dividend, UOB is the highest at 3.6%. This is trailing 12 months dividend yield, all right? And for OCBC is at 3.4%, not far off, all right? So you can see out of these 3 comparison, OCBC still present a lower valuation point than the other 2 banks. And now let's look at the geographical segment. So the local banks don't just have business in Singapore, but they have business overseas as well. And this is where their revenue composition differs, right? Where do they make their money from overseas? Which part of the world? So for DBS, mainly in Singapore, 60%, right? And they have China exposure about 25%. And then they have India and other parts of Southeast Asia at 7.5%. And you can see that their acquisition are mainly in a lot of the smaller banks in India as well as China, right? The recent one, Lakshmi Vilas Bank, this is in India, and another 13% in Shenzhen Rural Commercial Bank, that's in China. So the focus for DBS seems to be in these 2 countries, right? China and India. And it's not a bad strategy considering that these 2 are the largest populated places on earth, right? So you have very big addressable market if you are able to break into these 2 markets, right? So DBS tend to focus on the bigger countries in this case. And this is OCBC. Singapore is still the main driver, but in terms of overseas, they differ from DBS. Their exposure to China is about 16%, right? Lower. But they have a higher exposure to Indonesia and Malaysia, Southeast Asia market, which is about 24.9%, right? So for OCBC, Southeast Asia would probably, plus Singapore, would be about 75%, okay? So not so much in China, less so than DBS, and almost non-existent in India, okay? So that is where their overseas strategy and the market differ. UOB, likewise, Singapore majority, right? But UOB would even be bigger exposure in Southeast Asia than the other 2 banks. If you add Indonesia, Thailand, and Malaysia together, you get about 29%, right? 29%, okay? So that's almost a third of their revenue that comes from Southeast Asia ex Singapore, right? They are not so much into China and India. Okay, you can see they just lump it together as part of the other countries that they have exposure to, right? So this is where their geographical expansion and their geographical segments differ, okay? Even though their metrics are similar, but the region that they take their revenue from are slightly different. And in terms of products, right, mainly they make money from 2 business segments. One is consumer banking, that means individuals and businesses, The other one is institution banking, that means with other financial institutions, right? So you can see the biggest pie are the blue and the gray, okay, the retail and wholesale banking, right? For OCBC, they have an insurance arm, so that contributes about 12.6% because of their Great Eastern subsidiary, right, which is another listed company, separate listed company from OCBC, right? But for DBS and UOB, they don't have it. They just merely distribute insurance products by other companies, right? So they are distribution rather than the underwriters. And for OCBC and UOB, they also have bonds market, right? The treasury markets, right? Whereas for the UOB, not so, right? And the pie for wholesale and retail add together is about 88.9%. Okay, compared to OCBC is about 71%, and for DBS is about 78%, right? So you can see that for UOB, they are more really focused on the retail and the wholesale banking, right? They don't have a lot of other operations, right? Unlike OCBC and DBS, they have more diversified kind of product revenue segments. So there are a lot of tailwinds for Singapore banks. First of all, in the short term, we should be able to see economic recovery, and that would help the banks, right? Why? Because as the economy reopens, there will be more travelers, people may go out more often to spend on things, and there should be an increase in transaction fees, right? And banks issue credit cards, and so merchant facilities, payment facilities, they will take a cut of all these transaction fees. So when they go up, this transaction fee goes up, the banks will make more money, right? And when economy recovers, businesses or even individuals may buy more properties, businesses may want to borrow more money to expand, and the higher loan book will mean more money for the banks, and then the chances of lower bad debts will be higher, right? Because the business will start to have more money, individuals will start to have more money, and they will be able to repay their debts more timely. And with increasing wealth, the wealth management business should improve as well, right? Especially the last 1 year, the markets have been doing well, and some investors will see, oh yeah, good results, let's put more money to work, let them work harder for me and reach my retirement faster, right? So all this economic recovery in the short term is going to be good news for the banks, right? They're going to earn more money, all right? So we have already seen some of this impact. The Q1, Q2, Q3 in 2021, their numbers have been improving. And in terms of the medium term, there is a possibility that the interest rate may go up, right? This is not confirmed, okay, but it seems like if the inflation is here to stay, interest rate may go up to combat the threat of inflation. And when that happens, the banks will have more room to play around with their interest margins, right? So that would also increase their profitability. And in the longer term, it will be more of the fintech opportunities. All right, there can be a lot of digitization of the banking solutions, moving into cryptocurrency. All right, so all these fintech opportunities can be seen as a threat if the banks refuse to innovate. But I do think that the banks will eventually have to reinvent themselves, right, to create new kind of a solution, new experience for younger generation of consumers especially. Right, so they should see this as an opportunity, and we have seen some steps that they have taken to improve on that. So I want to share on that a bit more. Of course, some people will see that, oh, there are threats coming from the digital banking license holders, which have been announced, the license winners from the MAS, right, Central Bank. And the most famous will be Grab Singtel as well as C. Okay, both of them get a digital full bank license. That means they can do both retail as well as wholesale. Okay, and they have not issued any products yet, but I do think that they will create some pressure on the local banks to change, right? Like for example, the distribution of products would be via the app rather than via advisors or via the bank branches, and as well as Shopee may create that kind of loans that can allow you to buy just at the checkout area, right, without even using a credit card. Okay, so they can facilitate a loan for you, and they can track your purchase history, all these kind of things, and they'll be able to understand your credit behavior, and they will do an underwriting right on the spot. So these are some of the things that I think will change the way that banks operate currently, all right, but they are not going to pose a threat anytime soon, because their experience in banking needs to be built up, and they have not gone through any crises, and they may not even have the competency, because they will need to probably poach talents or experienced bankers from other banks, right? And they need to build out their competency over time. So it is not something that you can build a bank overnight, right? They are worthy challenges. I'm not writing them off. Just that these few years, I think it's unlikely to see an impact. Okay, and that said, it's not that the three banks will do nothing about it. They are also innovating, right? So when that happens, they will also be able to keep their place. Okay, so it's not easy for either party, whether is it the challenger or the incumbent. So it's an exciting phase for us to see how it will turn out. And then the other two are the digital wholesale banks. So they only deal with the financial institutions, and both are from China. One is a consortium, and one is from Ant Group, right, which is part of Alibaba. Okay, so these are the makeup of the digital first generation of digital banking license holders, and we yet to see any impact from them yet, right? So as I said, the local banks are also transforming. DBS have launched the crypto exchange and custody services, not for individuals, but more for businesses and probably accredited investor, right? Individuals possible, but they are accredited. And they are the first bank in Singapore to do it. All right, so you can see some bold moves over here, and that is a good sign that they are taking innovation seriously. And OCBC, you also have seen as a customer probably, right, you have seen a lot of new products, new experience kind of products like Robo Advisor. They came out with it as well, right, with a lot of thematic portfolios, some of these things, right, streamlining their processes. So I think that we should see more coming in the next few years as well, right? And UOB created a new digital banking brand called Tomorrow in Thailand and Indonesia. All right, so they tend to be more testing more new ideas in overseas market than in Singapore, right? And this is another sign, right? They are taking innovation seriously, not just saying for the sake of saying. Okay, there are some actions being taken. Of course, how effective they are is time will tell. All right, but I do think that these are good signs. So in summary, the Singapore banks have been resilient and been delivering consistent dividends in the past 20 years. Throughout any crisis, they have been giving dividends, more or less, right? But over the long run, the dividends have been raised and has grown, and they have also seen we have also seen their overseas expansion, right, rather than just staying in Singapore. So these are good signs that the banks are able to execute their strategy, execute their vision, and grow with results. Okay, so I do think that they have the experience and the competency to do so going forward. And I talk about the tailwinds, the short term in terms of economy reopening. We should see immediate impact to the bank results. They should improve in the coming quarters. And in the midterm, if their interest rate is rising, then the banks will enjoy even fatter margins, because they can play around with the net interest margins by lending out at a much higher interest rate than they used to be. And in the longer term, right, they will continue to expand in other parts of Asia, and it seems like they are getting some inroads, especially through the acquisition they've done. And with the technological transformation, if they really take it seriously and innovate and stay relevant, they will be able to protect a good part of their market share, even though the new digital banking licenses holders are coming in, right? And we also look at the valuation standpoint. The three banks have recovered their share price from COVID low, definitely, and DBS have been exceptional in terms of performance. But there still is there are still some value, right, in the other two players, OCBC, UOB, especially OCBC, right, is the cheapest among the three. Okay, so I do think that given all these tailwinds, the results for banks will continue to be better in the coming quarters, at least, right, if not for the first few years. Right, and in the longer term, there are even more positive things, of course, but it's harder to tell, right? Because the longer it is, the more possibility or more outcomes can happen, more crises can happen as well, right? But definitely in the shorter term, I do think that the banks do have a lot of positive going for them, and even in the crises in the future, I don't think long-term investors should be worried, right? Track record has been fantastic, past 20 years, consistent dividends going up, and they have weathered through many crises in the past. All right, so that is my take on the three banks, and hope you like what I've shared. Hope it has been insightful for you. Like this video and subscribe to the channel so that you will not miss any updates from our video. Thank you for watching.